What's up, everyone? I don't know if I'm actually live or not. I think I am officially live. Wanted to jump on here. I teased this over the weekend to see if people were interested in structuring equity deals. So how do you do it? How do you think through it? What are the considerations? So the reason why this initially came up is that I was posting the other day about how folks are really stuck in this all or nothing mindset. And what I mean by that is either I'm going to get paid cash or I'm not. Either I'm going to hire someone or I'm not. And there's just all this kind of all or nothing thinking. And in actuality, there's many different types of currency. There's many ways that you can be paid, right? You can be paid by getting access to someone's audience. You can get paid by getting invited to an event. You can get paid through cash, through equity. I listed, 6 or 7 different scenarios the other day of ways that you can get paid. And so with respect to equity, I'm doing this whole, with Nick later this week, this whole series called Revenue Multiplier. It's the methodology that I personally use to generate currently 10 different sources of revenue. And there's a specific sequence that we need to go through in terms of creating revenue. And so all that said, the question of whether or not you should consider equity depends on where you're at and what we call the revenue pyramid. And the revenue pyramid is kind of like the Maslow's hierarchy, only we've replaced the individual steps in Maslow's hierarchy with different terms. So the first few levels of the base of this pyramid relate to active income. And active income is exactly what it sounds like. It's income that you're actively involved in. It requires your time and energy, selling the product, offering the service, and delivering. That's active income. Then we have passive income. These are things like affiliate agreements, revenue shares, rental properties. These are passive investments. Now, the myth around passive investments is that you don't have to put in any work. They're passive. I don't really have to put in much work. That's not the case. With passive investments, there is an initial investment that you need to be willing to do of money or time, often both, to make it happen. And then at the top is portfolio income. These are basically investments that are going to yield you ongoing income. So typically when people think about portfolio income, they think about stocks and bonds, mutual funds, etc. But in my opinion, this is where equity deals go. They go at the top. These are portfolio income. And so initially, just like any other pyramid, your active and income needs to be the majority of your income. And then as you move up, portfolio income will be less, and then passive income, and then at the top, portfolio income. And over time, that needs to invert. So how you actually achieve financial freedom is when that pyramid has inverted and the majority of your income for your day-to-day is coming from portfolio income, then passive income, then active income. But if you have not sufficiently secured the active income and to a degree the passive income, then now is not the time for you to be doing these equity deals. So that's the initial sequence. Again, we're going to talk about this more in our revenue multiplier class that starts on Thursday with Nick. So assuming, though, you have built out a source of active income, ideally we advocate for multiple sources of active income, and you've built out some passive income, now we're going to be willing to accept or consider these equity deals. So if you have not built out the active and some passive and you get offered an equity deal, now's not the time. You have to say, sorry, I can't receive equity. I need to receive cash. And again, I will elaborate on this on Thursday. But essentially what you're doing is you're creating a more leveraged situation for yourself where you have to have this equity deal pay off ASAP because you don't have enough active income to pay your day-to-day. So you've over-leveraged yourself. So that's the reason why we can't necessarily take it out of sequence. So you need to understand where you are in the revenue pyramid to determine whether or not you can be open to an equity deal, even if it sounds too good to be true. In fact, when we have clients that work at Amazon, for example, we tell them until you've funded your core capital, you need to sell your Amazon stock. And they go, well, Amazon stock is on a tear. Well, if your goal is actually to get to financial security, the stock may continue to go up, But what you really want, but it could also go down at a rapid rate, as we saw a few weeks ago. And you don't want to have to swing back and forth from one day I can be retired to one day I can't. And so you want to lock in your core capital before you start taking on these additional risks. So same concept. So if it makes sense based off where you're at in the revenue pyramid, then where we go to is this checklist of what will the tax impact be? How can we align incentives? And how do we hedge our downside risks? So tax impact depends on the way the entity is set up and what the vesting schedule is. So if it's a partnership and you only receive a profits interest, meaning you only get a share of the profits as they come in, then you don't pay tax at the time of vesting. You just pay tax on any profits that get allocated to you. If it's a partnership and you get equity and profits interest, then you're going to pay taxes on the fair market value of the equity that was granted to you. So if you're granted a stake that's worth $500,000 in a partnership and invest right away, now all of a sudden you're paying tax on that $500,000. So are you in a position to pay that tax now is the lead domino question. And part of what you're going to want to look at is your tax rate now and your tax rate later, because while you just got a $500,000 equity grant, that's not liquid, meaning you can't just cash that out, chances are. So now you're paying tax with a liquid asset on something that is illiquid. Not ideal. If it's an S corporation or a C corporation, for S corporations, there's really no option for profits interest, and similarly with C corporations. So once you get the equity granted, you're going to pay tax on its value. But there are ways that you can hedge that downside risk. For example, and this is where we talk about back to kind of all or nothing. It doesn't have to be either we get equity or we don't. Ideally, what we're doing is we're splitting the problem in half. And we're going to talk about this a lot on Thursday. We want to split the problem in half. And so how do we, because it's much easier to deal with these two smaller parts than trying to address the bigger whole problem. So ideally, we split the problem in half, and then we can solve a problem over here and a problem over there. This is the whole concept of hedging downside risk. So let's split the problem in half. So we want two things. We want to get ongoing cash, some percentage of profits, but we also want equity. So let's split that in half. And let's say, because I don't want to pay tax on the deal now, let me get a percentage of profits, essentially as a contractor, for in perpetuity. I want a percentage of profits paid to me, basically 1099. So I don't have equity. I basically have this profits interest, so I'm not going to pay tax. And separately, I want what's called phantom stock. A phantom stock is basically I don't have equity until something happens. So I don't have equity until you sell the business. If you sell the business, then immediately my stock vests and I'm included as part of the transaction. So if I had 20% phantom stock and the company sells for $1 million, I'm going to get 20% of that $1 million. I just didn't have equity before the date of this transaction. So the transaction occurs, that automatically triggers my equity in the business, and then I get a piece of that sale. So we're going to say, let's get profits interest on an ongoing basis so that I'm compensated and incentives are aligned. And let's consider phantom stock because I don't necessarily want to pay cash now. I want some triggering event. Now, the problem with the triggering event, though, and this is where we go to hedging downside risk, is that might be years and years and years and years away. And so now we're contributing all this time. And so we want to be able to hedge our downside risks. And so this goes back to the incentives. Why is the person offering you equity to begin with? And why are you interested in it? And I have some criteria for whether or not I'm going to be interested in something. And that's going to be something that we're going to talk about in the revenue multiplier class. There's not enough time to go through it right now, but it's very similar to the 4 lenses that we talk about in cash flow engineering to evaluate whether or not something is worth pursuing to begin with. But we want to understand those risks, and then we want to hedge the downside. So we may say something to the effect of phantom stock, it's going to vest the sooner of 5 years or the time of sale. So I don't want to wait forever, but I want there to be So there needs to be some timeline where I get this equity. And then I'm also given time, because I'm getting a percentage of profits, to be able to save up towards paying the tax when I do vest. So some combination of the sooner of a time when the stock sells, or 5 years or 10 years or 3 years. It depends on what you're concerned about. And so we're hedging that downside risk. But also what you want to hedge against is maybe this company gets mismanaged, maybe things just don't play out the way that you expect. And so that's where I would say things like, we have to implement these mandatory reserves. And I have a whole set of rules for what reserves are. We need to put these reserves in place, because you could give me 10% or 20%. But if the company ends up being valued $0 because we go bankrupt, 10% or 20% or 100% of zero is still zero. So I need to make sure the business remains liquid and solvent. So some reserve framework, ideally some ongoing meetings. Maybe it's quarterly, maybe it's monthly. You're going to get the financial statement package. I would say at least quarterly, we need to do cash flow engineering. That's my area of expertise. So presumably someone who's bringing me on is wanting that expertise to begin with. I'm trying to hedge this downside risk that I have equity. I pour a bunch of blood, sweat, and tears into it, and now it's worth $0 in the future. So we want to hedge those downside risk. And then lastly, what is the incentive of the person offering you equity to begin with? Make sure that you get some additional bump for helping or ensuring that happens. So if we want to hit a certain size, well, when that happens, I get some additional equity. I want my incentives to be aligned as well. So whatever those major incentives are for the person who's offering you equity, that those are trigger points for you to invest some additional amount. And so just to summarize, the first consideration is, where are you at on the revenue pyramid? Does it even make sense for you to be considering an equity deal? If yes, then we need to evaluate the tax impact. We need to align incentives, and then we need to hedge downside risk. Those are the components to it all. Thanks for tuning in. If you want to hear more about kind of this methodology in the sequence, because this is kind of the last in the sequence of events, then that's our revenue multiplier methodology that Nick and I are going over starting on Thursday. Hope that was helpful. Thanks.